As an investor, what you need to do is understanding that you need to segregate in your investments, companies that are making the sustaining capital investments. Ironically, the people who are cannibalizing themselves, who aren't making the sustaining capital investments, well, you asked three questions there, so I'll try to answer all three.
Right.
For the investment part of my portfolio, which is most of my portfolio, I'm not in the Explorers. I'm in the Exxons of the world. I don't need to take alpha risk. Your gross thesis is right.
Yeah.
When the capital expenditure cycle kicks up, particularly if Venezuela stabilizes, and you get a realistic fiscal code in Venezuela, many of whom have talked to me because they've submitted portfolios to me, commonly say, well, Rick, you have access to all these people, right? Rob McEwen won't talk to me. Wrong. A good entrepreneur is so excited about what he or she is doing that they can't wait to talk to you.
Yeah.
They don't want to talk to you about the Super Bowl. They don't give a damn about the halftime act. That's nothing that matters to them. They don't want to talk to you about golf. Many of them don't even want to talk to you about their grandchildren. They want to talk to you about their company. And somebody who isn't that involved, isn't that fanatic, is telling you something too. It means they don't have the drive to make it.
Yeah. Couldn't agree more. So I'll put a link in the show notes to your conference. Rick, when is it? Where is it at? But I'll put
July
a link
6th through 10, Boca Raton, Florida, the Boca Resort. For those of you who don't know it, 180 acres in downtown Boca, half a mile of Atlantic Ocean waterfront, a palace. Lots to do there, separate and apart from learning, but I encourage you to spend most of your time on learning. If you can't make it to Boca, and by the way, we're going to sell out of physical seats within 30 days.
Yeah.
If you can't make it physically, which I would prefer, you can join 3,000 people in 33 countries online, live stream. However you join, live or live stream, you'll have access to the recordings and you'll need them. We're going to give you 46 hours of material, some of which occurs concurrently, over 4 days. There's no way you can take it in. You cannot take it in. I put on the conference. I select the speakers. I select the exhibitors. And I still have to play the tapes. So to get your money's worth, it isn't 4 days of your life. It's at least 8. 4 days live, and then 4 more days reviewing the tapes. And by the way, listen to the interviews before the conference. Come to the conference fully armed. I interview the exhibitors. I interview the speakers. If you pay attention ahead of time to what matters to you, you can use your time at the conference more efficiently.
Markets rarely move in isolation. When one sector overheats, capital often searches for opportunity elsewhere. After a powerful surge in gold equities through 2025, many investors are now debating whether money is rotating toward energy. Historically, such rotations occur when valuations stretch and short-term enthusiasm fades. However, seasoned investors don't chase rotation. They exploit it. When momentum traders exit one theme to pursue another, temporary mispricing can emerge. The disciplined approach is not to predict every shift, but to recognize when sentiment drives prices beyond fundamentals. In cyclical industries, emotional flows frequently create the best long-term entry points.
I kind of don't do capital rotation myself. I take advantage of other people's capital rotation when they're wrong. I agree with you that gold gave us too much last year. I think gold trades a lot higher over 10 years.
Right.
But I think the tensions come out of that coiled spring that we talked about earlier in the interview. So right. I wouldn't look for a repeat of 25 and 26.
Sure.
I would look for a lot of volatility, as we said earlier, and I think that's a good thing. I think in the very, very near term, oil's ahead of itself too. Trading up from 52 to 65 in the context of the Iran conflict in Venezuela. You know, that's a news trade, and guys who trade news usually lose. What I like about the oil business is that it's fundamentally mispriced. There's a lot of price elasticity or demand inelasticity. I don't know what you pay in your state for gasoline. Let's say it's $3 a gallon. You might not want to, but you would pay $6. If your choice is 6 or your car doesn't start, you're going to pay the 6. So there's a lot of room for the price to rise. And the industry is underinvesting in sustaining capital expense between $1 and $2 billion a day. Now, that doesn't impact them in terms of their production in 26 or maybe 27. But 28, 29, it starts to bite.
Yeah.
2 years ago, I could say that this deferred sustaining capital investments was happening among big companies who were returning capital to shareholders, and it was happening in state-owned firms who were diverting free cash flow to politically expedient domestic spending programs. Now, like Continental Resources, Ham, he has taken his rig count in the Williston Basin down from 18 rigs to none.
Jeez.
What he said is that basin doesn't support drilling at $60 oil. The truth is, people, when they look at the oil business, they confuse the capital structure. They look at the lifting cost of oil, which might be 15, 18 bucks a barrel, and they say, well, these guys are making a shitload of money at 60. That's wrong. That doesn't include amortization and depreciation.
Yep.
It doesn't include cost of capital, and it doesn't include tax.
Yeah.
The fully loaded cost to produce a barrel of oil worldwide, if you include Pemex, National Iranian Oil Company, PDVSA, is closer to 60 bucks a barrel. If you add back theft, which is what I call tax and royalties, and cost of capital. So you make the stuff for 60, you sell it for 52, lose $8 a barrel, you do it 102 times a day, it gets unpleasant. So unpleasant that, as I say, the industry is underinvesting substantially. As an investor, what you need to do is, understanding that, you need to segregate in your investments companies that are making the sustaining capital investments. Ironically, the people who are cannibalizing themselves, who aren't making the sustaining capital investments, are paying high dividends and getting share buybacks. So the companies who are making the wrong decisions are being rewarded in the market. And I particularly like that.
Right.
I particularly like it when my competition, who is often smarter than I, is doing the wrong things for the wrong reason. And you're seeing that happen in spades in the oil and gas business today. Just in spades.
Oil's recent rally has been fueled by geopolitical headlines, tensions in the Middle East, sanctions, and supply concerns. Yet beneath the news cycle lies a structural issue: underinvestment. For years, global producers have reduced spending on sustaining capital and new exploration. The International Energy Agency has repeatedly warned that insufficient upstream investment could tighten supply later this decade. While prices may retreat in the short term, the deeper imbalance remains. Energy demand is relatively inelastic. Consumers may complain about fuel prices, but transportation systems still depend on petroleum. When supply discipline collides with steady demand, price corrections can quickly transform into powerful recoveries.
And
near term, I think the price comes down.
All right.
It's trading up on news.
Agreed.
The news matters much less than people think it does. Near term, I would love to see the oil price back below 60.
Yeah.
But I think the oil price needs to be at a minimum 70. The oil market doesn't care what I think the price should be, first of all. So that's an opinion as opposed to a fundamental. And markets don't go to their equilibrium. They overshoot both ways. What's more important to me is that the consequence of systemic underinvestment in sustaining capital and a hiatus in new capital. I mean, nobody other than Exxon is making big project investments, not sustaining capital, but new capital. The consequence of that is that 3 years from now, it is almost certain that the current production surplus, which hangs over the market, becomes a deficit.
Yeah.
You will remember, Andy, the collapse in oil prices that we saw early on in the COVID time, when demand for transportation fuel fell apart. And the oil quote declined from 92 all the way to zero before recovering at 20 bucks. At $20, it was pretty clear that within 2.5 or 3 years, either the oil price went above 60 or your car wouldn't start. Those were the only two choices.
Mm-hmm.
And the consequence of 2 years of systemic underinvestment in COVID times meant that the oil price didn't recover to 60, which is what it had to do. It recovered to 85.
Right.
And I think that's what we see again.
Many investors misunderstand production economics. They focus on lifting costs, the expense of extracting oil from the ground, while ignoring full cycle costs such as depreciation, capital replacement, and taxation. When these are included, the global cost of maintaining supply rises substantially. During the COVID shock, collapsing demand drove oil prices briefly below zero. The aftermath was predictable. Investment froze, projects were canceled, and supply growth stalled. By 2022, prices rebounded sharply. This pattern demonstrates a core truth. Energy markets overshoot in both directions. Sustained underinvestment today could create future deficits, forcing prices higher to restore equilibrium.
You asked 3 questions there, so I'll try to answer all 3.
Right.
For the investment part of my portfolio, which is most of my portfolio, I'm not in the explorers. I'm in the Exxons of the world.
Mm-hmm.
I don't need to take alpha risk because there's so much money to be made in beta.
Right.
You know, if you would have asked me a year ago what I do in the oil business, I'd say Exxon. You know, just relax, buy the best. I was on record as saying that I thought Exxon was a 5-year triple from 100.
Yeah.
What do you want, right? You get a 3% yield while you wait, a 5-year triple? Come on.
Yeah.
You know, this doesn't require luck. The only thing it requires you to do is sit still. And I'm, you know, at my age, I'm good at that. So now, in terms of investments, I have a much more full portfolio. Where I wasn't was speculation. In other words, my speculative portfolio in oil and gas, unlike my speculative portfolio in mining, was pretty empty.
Mm-hmm.
And what appealed to me was that there was one subset of oil juniors that the market hadn't caught on to at all. The 200 million market cap Western Canadian Sedimentary Basin stock has moved from a $200 million valuation to a $280 million valuation. Is it over? No. But is that $280 million valuation substantially cheaper than a $6 or $7 billion Canadian valuation for a better company? No.
Mm-hmm.
So I'd rather be in the bigger company with less risk.
Yeah.
With the international offshore explorers, these things are truly orphans. They are truly, truly, truly orphans. I look at the trading pattern, and the existence of a bid moves the stock up. The existence of an offer moves the stock down. I mean, these things are trading by appointment.
Yeah.
So I know that I have to use good till cancel limit orders, but sometimes there's somebody who's been waiting to get off.
And they'll hit the bid.
Well, they'll wait.
I felt it, yeah.
They'll see if the thing comes up as a consequence of the bid. But then, poof, you know, boom. And that's exactly the market I love. I love illiquid markets, mispricing that occurs because of illiquidity, and a real anomalous.
For long-term investors, scale and stability often outweigh excitement. Integrated majors like ExxonMobil provide diversified exposure, strong balance sheets, and dividend income. In contrast, offshore exploration juniors offer asymmetrical upside but higher risk and illiquidity. Some investors allocate most capital to established producers while reserving a smaller portion for high-risk exploration plays. Illiquid stocks, though volatile, can present mispricing opportunities precisely because few participants analyze them carefully. The key distinction is psychological preparedness. Beta exposure through industry leaders requires patience. Alpha exposure through explorers demands tolerance for uncertainty and potential drawdowns.
The difference between risk and reward, with the caveat that I'm both financially and psychologically able to bear the risk.
Yeah. Oil services, do you have any of those, or what are your thoughts?
I do. I need to say, I've been speculating on oil service stocks for about 50 years.
Yeah.
And unfortunately, I'm still not all that good at it. That comes in process and technology. And I spend so much time doing upstream analysis in oil and gas that I haven't kept up with the service technology. I own Schlumberger because I think it's the most technologically advanced oil field service stock in the world. And I think they'll continue to be. Their research and development expenditure in seismic and logging, just their annual expenditure exceeds the gross sales of many of their competitors.
Yeah, stupid.
And where they have a 3 or 4 year technical advantage now, 3 or 4 years from now, when the competitors catch up, Schlumberger will be 4 or 5 years ahead.
Right.
That's a great business. As a young man, I had the extreme good fortune of working for a private oil and gas family that was extremely sophisticated. Well, two families, a partnership, extremely sophisticated. And they let me get my hands dirty in all parts of the business. I mean, my real job was to run around the world and tell their story and raise money. But they let me do everything just to make me a better employee. And one of the things they let me do was spec out the costs on a couple of wells. And I remember on one particular well, the wireline logging bill was $90,000, and I found a competitor that would log it for $50,000. And I went to my boss. I said, "I saved you $40,000." And I remember he sat me down. He says, "Rick, this is going to be a real good lesson for you. I'm going to make a $3 million completion based on the data from that log, and a Schlumberger log for 90 is a much better deal than their competitor at 50. The data was enough better that he would pay almost double the cost to get the data." And I remember thinking, that's a good business.
Yeah.
Another way to approach an energy cycle is through service providers, the companies supplying technology, drilling, and seismic expertise. Firms such as Schlumberger invest heavily in research and development, often maintaining technological advantages years ahead of competitors. When capital expenditure cycles expand, service companies can benefit significantly. However, this segment requires technical understanding. Unlike the simple tools of the 19th century gold rush, modern oil extraction depends on complex data, advanced logging systems, and offshore engineering precision. Investors must evaluate not only commodity prices, but also technological leadership and competitive positioning.
Your gross thesis is right.
Yeah.
When the capital expenditure cycle kicks up, particularly if Venezuela stabilizes and you get a realistic fiscal code in Venezuela, there's going to be $100 billion spent there.
Yeah. Right?
A lot of guys are going to make it. The difficulty is when you use the gold rush in 1849 as an analogy, there was no analysis of technology that you needed to do. A shovel was a shovel, a pick was a pick, a stake was a stake, and a pair of breeches, before the improvement that Levi's brought in, was a pair of breeches. You had to worry about logistics. How do you get the pick there? Stuff like that. But the analysis that you have to do to play the game today is analyzing competing technologies. And that's, I've learned at least, much, much, much harder. I'm going to buy something with a symbol RIG, Global Marine, which is merging with their second largest competitor, and will be not merely the largest, but far and away the largest provider of offshore drilling services. I'm going to do that because of hegemony in some basins that are going to get drilled.
Yeah.
And the synergies involved in the elimination of duplicate overheads between these two companies. I'm going to do that. That's not a real sophisticated play for me.
Right.
The biggest and the best is something I can afford to own.
Yeah.
I'm going to own, well, I do own Schlumberger for the same reason. Probably I should own Halliburton, but I'm not sure at $60 how much demand there's going to be for pressure pumping in the Permian and other basins. In other words, Halliburton's best days in terms of the pressure pumping business may be behind it. And I see enough opportunity myself in Rig and Schlumberger that I don't need to own Halliburton. And I certainly don't need to come down the quality trail anymore, because I'm competing with young analysts in Houston who know those businesses inside out.
Right.
And they're going to kick my ass every day.
Yeah, well, that's exactly it. I would just stick to the big boys in this,
Yep. Yep.
and I don't need to really.
Successful resource investing extends beyond stock selection. Access to experienced professionals, structured education, and rigorous analysis can dramatically improve decision-making. Platforms such as Rule Investment Media provide portfolio reviews, educational modules, and deep dive workshops focused on sectors like silver, uranium, and regional exploration plays. The philosophy emphasizes personal accountability, learn the fundamentals, evaluate risk independently, and prepare for volatility. In commodity markets, fortune rarely favors the impatient. Instead, it rewards those who combine research, resilience, and strategic timing, transforming cyclical swings into calculated opportunity rather than emotional reaction.